Hi, and welcome to Homework Rant by Professor Elizabeth Keating. In these various videos, I'm going to be walking through how to solve selected problems from the Introduction to Financial Accounting textbook by Horngren, Sundam, Elliott, and Philbrick. And I'll be drawing from edition number 11, which is also the same as the second custom edition being used at Boston University. The goals and objectives for this homework problem are: first, I'm going to show you an overview of a simple financial statement template. Part of the problem will be asking you to identify the difference between assets, liabilities, and equity accounts. We'll then be using the template to record a few transactions, take the template and use it to create a closing balance sheet. And finally, that closing balance sheet that we're going to create is going to be presented in good form. What you can see displayed here in blue is the balance sheet equation, assets equals liabilities plus equity. Using the financial statement template, we're going to lay out the different accounts in the same manner. I'll get to later how we'd made a decision about some of the assets, liabilities, and equity, but for right now what you can notice, the assets are on the left, then there's a gap, then there's liabilities, and finally there's equity accounts. The next step in the process of using a financial statement template is to record individual transactions or journal entries. We'll be doing that for this example in a moment, but what you can see in the red backs right now is the section highlighted where those transactions will be recorded. One transaction will be reported per row. Finally, at the end of the exercise, the bottom row will be filled in, the closing balance that's depicted there in light blue. What you'll be doing is adding up the numbers starting with the opening balance in purple at the top and then adding and subtracting what's occurring in each column, with black numbers being positive and adding to the total and red numbers in brackets being negative, reducing the total. This particular video is going to be looking at problem number 31 from chapter 1. This problem is asking you to prepare a balance sheet, and I'm going to use the method of the financial statement template in order to solve it. What's actually happening in the problem is we're looking at the Jacksonville Corporation, and we start with a balance sheet on March 30th, 2000 X01, and we're given a set of starting balances. So your first goal in looking at the set of starting balances is to look at the names of the various accounts and to determine whether they're assets, liabilities, or equity accounts. So we'll start by identifying the cash accounts. There's cash of $14,000, which is the first one listed. Then we can find inventory, which is the third one listed, of $40,000. So we'll write that down. Then we'll write down furniture and fixtures, which is a type of fixed asset, of $3,000. And then there's a second fixed asset account, which is machinery and equipment, of $15,000. There's land of $14,000, and there's building of $24,000. As far as the ordering in this problem, cash should be the first column and inventory the second. Cash is the most liquid asset, so it goes first, and then we go in order of liquidity after that, which is inventory. The other four accounts are all fixed assets, so you really could put them in any order, the head of any column. Often people decide they want land first, but it doesn't have to be the case. So we have assembled that group of accounts, all of which are assets. So all of them are being displayed as columns, and all are being shown on the left-hand side of the equal sign in the financial statement template. The next thing to do is to go through and identify of the remaining accounts which are liabilities and which are equity. So we have accounts payable, or A/P, notes payable, or N/P, and long-term debt, which as an abbreviation is LTD. We'll want to put accounts payable first, as that is a current liability, will be paid off the most quickly, and that's $8,000. And then notes payable and long-term debt are both forms of financing. Generally, notes payable are paid off sooner. They don't have to be than long-term debt. So we'll have notes payable in the first column there is $10,000, and then long-term debt of $12,000, which then leaves us with one equity account, which is the paid-in capital account, of $80,000. And so we now have this nicely set up as far as an opening balance sheet. We will actually now look at trying to record a set of transactions. Thank you. The first transaction that we're going to look at is number 1 in the problem, which is purchased merchandise on account for $3,000. And so you could have labeled the head of the column merchandise inventory, or simply inventory. Any of those would have been fine. So we're purchasing inventory. That means inventory is going up. So the increase in inventory is shown as a positive number, 3,000, in the inventory column. And now we need an offset, something to make the this particular row, the row number 1, balance. So we're going to increase accounts payable. So accounts payable are the unpaid bills that we have. And so the term on account means we're going to be paying in the future. So we're not paying with cash. So we have more unpaid bills at the point in time we bought this inventory. So you'll see a positive $3,000 in the accounts payable account. If this problem had said on credit instead of on account, that means the same thing, and so we similarly would have put $3,000 into accounts payable. Okay, now we're going to move on to number 2, which says sold at cost for $1,000 cash some furniture that was not needed. Very poorly constructed sentence. So what we can make out is the amount of the transaction is $1,000, and that we now have more cash. So we have a positive $1,000 being shown in the cash column, and that we're sacrificing or giving up some furniture. And there's no reference in number 2 about the firm having profited, gained, or lost anything because of this transaction. So we will make the assumption that the furnitures that was on our books that we're giving up was worth $1,000. So we're simply exchanging furniture that you're giving up for cash. So the giving up of the furniture, we're going to display and show as a negative $1,000 in the furniture and fixture column. Now looking at number 3, issued additional capital stock for machinery and equipment valued at $12,000. So the first part of that sentence, issued additional capital stock, means we're giving out stock certificates to some owners worth $12,000. So we'll put a positive $12,000 in the paid-in capital column. Now, rather than these investors giving us cash, they're giving us furniture and equipment, machinery and equipment. So we will now have $12,000 more in the M&E column. So we have record a positive $12,000 there. Now let's look at the fourth point. Purchased land for $25,000, of which $10,000 was paid in cash, the remaining being represented by a 5-year note, parentheses, long-term debt. So we're receiving cash worth $25,000, so we'll put a positive $25,000 in the land account. We're sacrificing, giving up $10,000 in cash, so we'll put a negative $10,000 in the cash column, and we'll put brackets around it to make it clear that it's a decline. And since we're using colors here, we'll use the color red, again to indicate a negative number. So now that's 2 out of the 3 pieces of this particular journal entry. And so we have assets going up by $25,000 in the form of land and dropping by $10,000 in the form of cash. So that gives us a net change in assets of $15,000 that we then need to find an offsetting component to this journal entry. So the remaining part of the journal entry we need to find is $15,000. And they tell us that we find a way to get the land by issuing a note, a long-term debt note of 5 years in duration. So we're going to put $15,000 into the long-term debt column. Now we'll come to the fifth and last transaction. The building was valued by professional appraisers at $43,000. So we can look and see that in the opening balance sheet, the building was worth $24,000. And now appraisers are valuing it at $43,000. We're not going to make a journal entry. Why is that? We have certain rules about how we value certain accounts. And in the case of property, plant, and equipment, in the United States, we do not write up any buildings or any form of fixed assets. We may decrease those values if we find they have dropped, but we may not increase them. Why is that? It is that fixed assets we can find many different people, appraisers, to provide valuations. We don't know that that's a hard or solid number, and so we can't really feel like that appraisal is fully objective. If this was a stock that was actively traded on an active exchange, we would be willing to increase the value. But since it's property, plant, or equipment, fixed assets, we will not. So in the case of this fifth item, we're not going to record a journal entry, so you can see the row is blank. And so now we've concluded our transactions, and we can go down through the process of adding each column and finding the ending balance. So we will start with the number at the top of the column in purple in the opening balance. We will add all the positive black numbers, and we will subtract, deduct the red numbers to come up with the closing balances. And so since the opening balance was equal and each journal entry equaled, then when we add it all together, ultimately we have the things on the right equaling the things on the left. And so we have a balanced balance sheet. So our last step in our process is to complete the instructions at the bottom of the problem, which is to prepare in good form a balance sheet dated March 31st, 20x1, showing supporting computations for all new amounts. The support is what we created in the financial statement template. So now what we're going to do is prepare the balance sheet. So what you can see depicted here is a classified balance sheet. By that, we mean we are displaying both the current elements and the non-current or long-term elements separately. So we have at the top the name of the company, Jacksonville Corporation. Right below it, the name of the schedule of information we're providing, which is the balance sheet. Another name for that is the statement of financial condition. And then below that, the date. So a balance sheet is a snapshot in time, and we're taking that snapshot on March 31st, 20x1, and so we have that date written down. We have two sections. The section on the left is the assets, the section on the right is the liabilities plus stockholders' equity. We need the assets to equal the sum of the liabilities and stockholders' equity. And now what we're going to do is list the various accounts and their values on March 31st, which is what we're going to do is simply read straight off the bottom of the balance sheet template, the financial statement template we prepared. So you can see now with the red box, the line where we're going to grab the numbers from in order to prepare the ending balance sheet. So we've taken now each of those numbers, filled them in to the balance sheet that we have displayed, and we've now prepared a couple of subtotals and totals. So we have total current assets, which is cash plus merchandise inventory on the asset side. On the liability side, we have total current liabilities, which is only the amount of the accounts payable. We then have the total amount of assets, which we add up the total current assets and all the numbers below it, which are the fixed assets. And we come up on the asset side with $140,000. Over on the liability and shareholders' equity side, we're going to add together the current liabilities of 11, the notes payable of 10, and the long-term debt of 27,000 for a total of the liabilities of 48,000. So we've got to provide a subtotal there of that. And then the only equity we have presented is the paid-in capital of 92. And so when we add the 48 of total liabilities to the 92 in shareholders' equity, we end up with a grand total on that side that's liabilities plus equity of $140,000. So we can see in good form that we have at the top of each column a $sign, at the bottom of each column a $sign, and we have those double underscores with total assets and then over with total liabilities and stockholders' equity to show that we have a grand total. No more is being added after we see that grand total. So that covers in detail the solution to 1-31.